Good evening, everyone. Good evening. Let me just check that my audio is, I had green lights. Oh, it's all good. It's all good. From my side, so good evening, everyone. My name is Adam from Trade with Precision, and welcome to the Traders Tool Fibonacci retracement. We'll also have a quick look at Fibonacci expansion as well and do some live market analysis. So the first thing I would like to do is an audio check. Can you please send me any responses into the questions box and just let me know that you can hear me loudly and clearly? And hopefully that's the case. Thank you very much. Some nice responsiveness there. Thank you very much. Excellent. So, ladies and gents, thanks. If you want to communicate with me, use the questions box as opposed to raising your hand. There is always a raise hand option, but I never know what that means. Just ask me a question and I will get to it as soon as possible. So we've got a risk disclaimer or two to go through, and while you are reading that, I will tell you a little bit about myself. My name is Adam Harris. Again, I'm one of the market analysts and traders with Trade with Precision. I am usually based in the city of London, but this evening I'm speaking to you today from Rome in Italy, and next week I'll probably be in Spain. We'll see. I'm just enjoying a little bit of a break, but I trade on my holidays, and it's only usually a little bit of time here and there. And it's a very warm evening. I think it's about 32 at the moment in Rome. It's been a very hot day. So I'm a trend-based trader. I think that's an important distinction. I look for trending markets as opposed to volatile, choppy markets, and I usually trade in the direction of the markets as well. Sorry, let's just have a look at the comments. You can hear but not see. Okay, let's just have a look here. You should be able to see the screen. So when I activate it, I also have the ability here to see what you're seeing. So if I look at the audience view, I can see the slides. So you should be able to see that. Let me know if you have any difficulties with that. Usually the solution is to exit and rejoin. Good evening. Okay, so on the agenda for this evening, we're going to be talking about setting up and understanding Fibonacci tools. We're going to talk about how to go about adding Fibonacci tools to your graphs. And then, of course, we're going to talk about finding trades using the Fibonacci tools. And I would say more specifically about finding trade entries as in addition to finding trades. Okay, so before we go to the charts and we start applying this in real time, I want to give you a quick overview of the approach here. So I'm just going to quickly adjust my drawing tools, and in terms of colors, let's just go with that. Quickly do this. So we'll go with light blue. We'll do this. Okay, so, and I'm curious, I'm going to ask the room, all of you, would you like to be more of a day trader? So that means that you'd be trading the lower time frames, or do you ultimately see yourself as trading end of day? Do you want to be kind of, look, I want to, for example, if you're based in the United Kingdom, the end of day market is going to close at 10 o'clock, which is 5 p.m. in New York. And that's usually where the daily candle closes, and you look to take trades, generally speaking, on the daily, maybe the weekly charts, possibly, or even on the 4-hour charts. These days, it's become more acceptable to include the 4-hour time frame because it's not very frequent. So you can check for trades every couple of hours, and so in other words, your frequency of sitting in front of the computers is a lot less. Okay, so with end of day trading, you look at the daily chart, it's half an hour a day. You look at it at 10 o'clock at night, and you don't check it again until 10 o'clock the next day. Alternatively, you might be looking to become a day trader. So day trader is somewhere between 2 and 5 hours a day, depending on the individual. We're not talking about scalping here, all right? We're talking about trading. You can trade on a 1-minute time frame. It doesn't have to be scalping because it's on a 1-minute time frame, and it's usually on the 15-minute time frame, somewhere between the 15 minutes and 1 hour, possibly on the 4-hour as well. The point is that when we're day trading, we're looking for trades that will usually close between today and tomorrow. In other words, within the next hour to 24 hours, usually. Okay, so here's the thing. Any market you trade, any time frame you trade, can always be divided into one of two categories. It can only exist in one of these two states, guys. It is either not trending, which means that it's mixing up its highs and lows and not offering any clarity on its direction or intention. So why is it important that we know how to identify if a market is not trending? Why? Because it tells us we should not be engaging in that market. Simply put, from a practical sense, from a practical perspective, that market isn't going anywhere. And also for a buyer or a seller, it's like flipping a coin. It doesn't really give us a real edge. There's no probabilities of success in our favor. So as a general rule, markets that are choppy, going sideways, that are very volatile, tend to take our money statistically rather than provide us with potential profits statistically. So if you take 100 trades, 60 to 70 of those in a ranging, noisy market will take your money from you versus the other state that a market can exist in, which is a trend. So either a trend to the upside or a trend to the downside. Okay, so excuse the childlike version drawing there, but that's it. So any market, any time frame is either, right now, is either trending or not trending. If it's not trending, we should avoid it until further notice. Now, if it's not trending on the daily, we can leave it for a few days. So this is also a time saver, guys. It means that I can do a scan of the markets and eliminate the ones that aren't trending until tomorrow or until next week. I can forget about them and I can shorten my list to the markets that are trending really well. So today, off the top of my head, the yen pairs, beautiful, the best money-making charts we've had in a long time. Relatively speaking, easy trading. Trading itself is never easy, but it gets easier over time. So I want you to think about it like this. Forget about money being a dirty word. Making money, these are the best conditions to make money, and so we call those trending market conditions. If we find these, I want you to imagine that those markets are, even though you haven't got in them yet, they offer the best opportunities. The highest probabilities of making money, the lowest probabilities of having losing trades. We can still have losing trades, but it's the lowest probability. So these are what we call core concepts, or what I call core concepts. This is the building blocks of trading. Let's just have a look at some of your responses to my comments here. And I love the interactivity, by the way. Day trader, cool, common, and you can jump between them. So the skills are transferable. So everything that I'm covering tonight can be used for either day trading or not. But a lot of people, to be honest, are not sure which one they should be. You don't really know. But the skills we're covering today will help you either way. Great, and actually I've got an answer here, which is combination of investor and trader, which is great. So let's clear that up because I'm going to add to it in a moment. The next thing is okay, so now the next thing is let's talk about, once we've determined that we have a really good trend, and I'm going to show you some garbage charts, which we should stay away from that are wasting our time. And this is the thing, every chart, every instrument goes through periods where it's trending and then periods where it's not trending. So when we're saying, okay, you're not trending today, you're not saying I don't care about you anymore, and in principle, you don't mean anything. We're just saying, look, at this point in time, today, I need to ideally find some money-making opportunities for today or this week, because I'm not an investor. This is not a casual thing. As a trader, I'm looking to actually physically earn a secondary or primary source of income. And so I need something that has got a high probability of moving today. And if I can get a good entry and I can take some profit, then I can make some money off you. I should be able to do that. So to give all of you a sense of what we think is reasonable for traders to do, and from experience, somewhere between 2 to 5 trades per day to 2 to 5 trades per week. Most, if you look at currencies and you include metals and oils, commodities, and you include the indices, throughout all of those, that's about 30 something charts. There should be 2 to 5 trading opportunities per week minimum, and possibly as much as 2 to 5 trades per day. So, and that's trading. It's not scalping, it's trading. All right. And it's up to the individual to determine if you go, okay, the trends are good today. Because some days when the trends are strong like they are today, you might take 10 trades because it's like, what's the word? Making hay while the sun shines. There's just so many opportunities you've got to do it. And when we go to the charts, it'll make sense to you. So the next thing that I want to talk about, because I'm going to pull all this together with Fibonacci, what I want you to have at the top of the hour is a clear understanding of potentially how you would build a routine to go look for trades. So I know that's possibly I've helped provide some clarity in terms of for your own life, how day trading works, or the routine that you can build up around it, how you can determine which markets are gonna, so that you should spend time on, which ones you can exclude, and then how you can go about finding entries. And then we can talk about processes for trade management as well. All right, so here's the thing. When a market is trending, and I'm going to use an uptrend as an example here, but obviously this applies to a downtrend as well. So we'll have an uptrend is by definition, has got kind of a minimum requirement is 4 points. It's got 2 high lows. So a low, and then it's got a high, and then it's got a higher low and a higher high. Okay, so the second it breaks this high, there we go, it becomes an uptrend. All right, might be a brief one, but that's what it is. A downtrend is lower highs and lower lows. So it's a series of those. And actually, the way I want you to think about it, it's like we're going to take this little guy, we'll call him Adam, and he's going to be standing on the beach and thinking about everything, and we've got the waves coming in. So the waves will come in like this and they'll come up like that, but it isn't just the waves. It's not the individual wave that comes in and goes out, it's the tide going in or tide going out. So you've got a series of individual waves, but collectively the waves over every few hours are obviously going in a particular direction. And it's the same within the markets. We don't just look at a single move. A single move doesn't really tell us which way the tide is going. It's a series of moves that tells us which way the tide is going and therefore which way we should be trading in, where the probabilities are in our favor. And we are focusing on the tide. So that's really basically where I'm going with this, is that if you can find a chart that is trending nicely, that right there gives you 50% of your edge. Just finding the right weather conditions, market weather conditions to engage in, is 50% of the work, ladies and gentlemen. Once you've done that, the probabilities exist on that chart to make you money, much already in your favor as opposed to against you. So this is what we want to do. So it's a series of moves that collectively gives us the tide. Now, the next part of that is working out, these are interesting ways in which the market moves. So if you're trying to sell your house, ideally, if you're trying to buy a house, what you really don't want to do, and people get frustrated about this, is when they buy a house, they buy it when the market is at its most overpriced. Okay, it's great if you can sell it at that point, but if we talk about buying a property, because we're talking about investing here as well, like the idea of getting in and out of markets, whether it's property or whether it's cryptos or whether it's trading, you very really want to get in at the point at which the market has exhausted itself. So there's always a push phase and a retracement, or a push and a pull, or an extension and a retracement. And we really don't want to get in as a habit on the push phase. Getting in on the push phase is higher risk. And of course, what it does is usually when we get in at that point, and this is our untrained approach, then the market tends to start coming back because it's overpriced. And so the reason for that is really straightforward. The market is made up of hundreds of thousands of participants getting in and out in real time. And the market itself doesn't know if it's overvalued or undervalued until it passes that point. So if you can imagine that the true value is being printed in real time as well, and as the market goes past its kind of its ideal value, it goes, oops, okay, I've gone too far, and then it starts to come back to it, and then it goes past it again, and then it tries to come back to it. So it's really only, for example, again, using that analogy of selling a property in your street, it's really only kind of, you go, well, how much could we sell it for, or what's cheap in this road? It's really only relative to other properties over time that you get a sense of, oh wow, maybe we could have sold it for more, or we were lucky there we sold it for the right amount, or we sold it too cheap. You really only have that because you have a frame of reference of other properties, and as they go up and down, where the highs and lows are. Okay, so this is what's happening in the markets like this. So the thing is that when the market for us is moving, and it's not just about the highs and lows as it goes, but it's the angle. So we've got, if the market is going this way, it's flat, it's not really going anywhere. If it goes like this, it's going almost parabolic, it's very strong, very fast moving. The best markets for us have an angle somewhere between kind of 30 and 45 degrees. They're really nice and sustainable. And so it's the angle of that, but it's also obviously the highs and lows. And so that true value tends to work its way through the middle. So what we don't want to do is get in at the top. So I'm not just talking about strategy here before we get to Fibonacci. I'm talking about the things we don't want to do. And no offense to anyone who already knows this. I kind of trade for a living. So these are the things that we have to build into the way that we behave in the way we're trading as habits. If we jump in at the top end of it, this is the second half of that move, that's kind of the worst point to get in on that move, because usually at that point the market has pushed too far and is getting ready to come back. Ideally, what we'd like to do, ideally and as often as possible, is capture, get in somewhere on the bottom part of the move and try to capture anywhere from 50 to 80% of the average move to the upside. Ladies and gents, that's more than enough for us to consistently make money. So we're going to be talking tonight about, I'm going to take this approach of what we'll call a 60% win frequency. Okay, win frequency, meaning that out of 100 trades, the approaches we're going to talk about today should win about 60% of the time. Possibly more as you get more and more experienced and your selection process improves, your eye for reading the markets improves, it'll go up to 70 or 80%. okay? But we're still gonna have somewhere between 20 and 40% losers out of all of those. And here's the thing, it's not just how often they win, it's how much they win when they win. So if we talk about the maximum idea of 1% per trade, why 1%? Why 1%? Because, let me check your questions. Okay, cool. Just let me know if I've answered your question about what's a trend, because I see you asked the question and then of course I've spoken about it. Let me know if I have actually answered it sufficiently. So why 1%? So it's interesting to me. It stems from originally from poker. Okay, it stems from originally from poker. When poker players, when you're playing around, imagine you're an amazing poker player. So you're playing at around a table, but you've got a kitty of money next to you. So here's the thing, you've got a great hand. You've got a fantastic hand. You should win. And so you decide to bet, say, kind of a third of your kitty on the table. You've got a good feeling about it. And randomly as it happens, the other person has a better hand. So it's not that you're not a good player or that you don't have a good hand. It's just that the other person has a better hand. So now the problem is you've lost like a kitty, you've lost a chunk of your money. And now the problem is that, okay, so then the next round you don't get a great hand and you're not even convinced you can bluff your way through it. So you kind of pass. So now what happens is the game starts to kind of move on without you. Or when it does, the problem is now that you don't really have enough cash to even stay in the game. And also the fact is that even if you now win, it's not really going to make up the money you lost. So 1% originally stemmed from that if you played a small enough amount of your kitty, then if you were wrong or the other person had a better hand or you just had a weird run of bad luck, that actually you didn't do so much damage to your kitty that when things started going your way again, you couldn't rebuild your account and actually go back into profits and start making more money. So they worked out, it's called the risk of ruin, and then a whole lot of mathematics went into it at MIT, and then it's just become canon with traders. Basically now 1% is that beautiful sweet spot where if you hit an extended losing streak, you can recover the losses really quickly. As soon as you move it to something like 3%, ladies and gentlemen, it wipes out like 60% of your account. So they talk about risk of ruin, saying that it's so sensitive. If you keep it at 1%, it'll take you a very long time to do any really big irreversible damage to your account. But as soon as you switch it up to like 3%, it can happen really quickly. And so we keep it at 1% or less. If you're interested, if you care, I risk anywhere from 0.1% to 0.5%, 0.5% per trade. But I'll have a lot of trades open, 7 to 10 trades. So this is the idea. And there are two things, by the way, that will destroy everybody who's attending tonight, who will destroy your self-confidence and your game and your money and your account. Our self-confidence is a key thing. You cannot trade consistently successfully if you are not in a happy or calm place. And what would get you into the worst possible place if you are panicking or stressing? Or do you think that you will be performing better under pressure like that when you've now damaged half your accounts and stressing about it? Do you think your game will improve or do you think it'll get worse? It will get worse. And so what happens is the first thing we want to do, ladies and gentlemen, is make sure that our future selves, so my future Adam, is not in a hole that he has to dig himself out of. I want to make sure that future Adam, all his best days of trading are still ahead of him. In other words, every time he sits down in the future, he might have small losses or be flat or have gains, but he's not going to have big losses. And so I'm always protecting future Adam against that situation. And that's what I want you to think about. You're protecting your future self and your account. There's two things that can destroy your account. You, me, okay, in other words, we can destroy our account or the market can. So when we use stop losses and we keep our risk at 1% or lower than that, we are protecting our existing cash. That's all. And if you want to know how much you can make, to give you a frame of reference, okay, 0.3% today per day. So in other words, 1/3% of profit each day will compound, I think, over 22 days to 6% per month, which compounds to 100% per year. You could double your account every year if you were just capable. And this is not to try and oversimplify it. This is not a sales pitch. This is just, I'm trying to say to you that the secret to doubling your money every year, which is a very good achievement, is small steps. So in other words, if you can do that or better, you're fine. But don't convince yourself that it has to be giant stuff. So we have a 60%, this is real world talk here, 60% win ratio, a win frequency. And ladies and gentlemen, a 3 to 1 win ratio. This is very important because it comes into the strategy when we talk about Fibonacci in a moment. 3 to 1 win ratio. That means that when we lose, we're risking 1%. We are risking 1%. When we hit our target, we're aiming on average for 3%, 3 times that. Okay, so that means if I risk 1%, I make 3%. If I risk 0.3%, I'll make 0.3% times 3. And so this is important because our winners are supposed to make more than our losers. Okay, we're going to take this approach. So we're going out fishing, we're going fishing every day, and our goal is to try to make more money from the market on average than it takes from us. And so this is our idea. So what we're going to be talking about today is a 3 to 1. We do this because this approach works for almost everybody. It gives you enough wins and enough profits, and the results are very good. And it's 2 to 5 trades per week or 2 to 5 trades per day if you're doing a lot, but it shouldn't be more than that. If you're doing 20 trades a day every single day, something's wrong. I've never met anyone who's done that and made big money, because somewhere along the line they are scalping and they're experiencing big losses usually. So there we go. That gives you a broad overview of the approach we have got. If we now start with a trend, and I'm going to finish this, then I'm going to look at the questions. So this is one of the interesting things that can happen. The market kind of breaks above an old high. So there's the old little high, and then it likes to kind of come back and then kind of test it. It almost as though it comes back halfway, which also happens to coincide with the previous high. And then it carries on. Or it goes up a bit and comes back a little bit of a period, or it goes up and then maybe it consolidates and then carries on. So what I've shown you here are a couple of variations. There's not an infinite number of ways the market can behave. There's a finite number, and here's a couple of different ways in which it can pull back. Okay, and so what we're going to be talking about today is principally how we can look for these pullback areas. That's what we're going to be doing today, ladies and gents. We're going to be trying to find ways in which the market can look for these pullbacks, and essentially also there's a flat level breakout. And the idea here. So this is pretty cool. One of the ways in which we can do this is we can look for these pullbacks and ideally look for entries in those, and we're going to use Fibonacci to help us do that. Let me look at your questions and then I'll carry on. Okay, cool. So the questions were, after how many higher highs and higher lows do you determine the entry and get worse? Yeah, thank you. So look, let's say the market's doing this. It's not going anywhere, but then it does this, suddenly breaks out, comes back and tests it and breaks a high. At this point, you have a breakout and you actually have a low and a high and a higher low and a high high. So usually the most aggressive traders would wait for that first pullback, and that will be their potential first trade. Some very advanced traders might wait for it to break out of the range and take this one, but this is your first valid one. So you've got your kind of confirmed uptrend, and then you could take that as your first trade. Okay, so over time, by the way, your confidence will improve. But let me tell you this, if you don't have to stress about your losses and your headspace is generally really calm, you will progress on the journey to consistent profits sooner, faster. You'll do that. Most people blow an account or go through really bad experiences or get themselves in a hole. And that's usually because they haven't been given the speech that I've just given you. I'm trying to spare you. On the journey, we go through all similar experiences. I'm just trying to, if it lands with 1 or 2 of you, I'm happy. Where I've spoken about why you don't need to risk more, why you should really focus on the technique and the game rather than the money. The money is a consequence of doing these things properly. And trading is not about complexity, guys. It is about doing the basic things really well. I promise you that. Okay, so what we're going to be doing is we're going to be looking, how are we going to find, first of all, we're going to find a trend. So your question to me is, okay, well, Adam, how do I know I'm looking at a trend? I'm going to show you on the charts. We're going to look at live charts, but I'm saying to you that as soon as you see a market that's going, let's do a downtrend just to mix things up. So you see a market, it's a bit of a mess, and then suddenly you see a strong move, pullback, and another strong move. That's the earliest stage at which I would say, okay, the market's moving. It's moving down, it's in a trend. Now I'm going to be looking for an entry into that. Okay, and so we're going to be talking with the Fibonacci tools are very good to help. They're a very useful way to help us identify support and resistance levels. If you said to me, Adam, this, should I be using Bollinger Bands? Should I be using this? Should I be using that? What are the most important indicators I need to be using? And the truth is that you can take everything off your charts except 2 things. You need price, which is the candlesticks, and you need horizontal levels. Because what does the market do? Forget about technical analysis versus fundamental analysis. If you have a market and it has a price like gold, the market goes from one price and then if it breaks through that price, it'll work its way down to the second or to the next level of price, basically what's called the path of least resistance. And then possibly at that point, it might come back up, or potentially it could find itself breaking through that price level and then heading down. So gold is a great example. If it breaks through $1,800, it's usually going to head down to say $1,700. This is pretty standard for things that have been around for ages. Sugar, euro, dollar, all these things, they tend to work their way to the next major level. Sometimes it's a round number, sometimes it's not. But we can see these price levels. Fundamental analysts will find them, and technical analysts will see them on the chart. So the two basic things that you can have and still trade profitably, and this is your goal on your journey to becoming a master trader. So your master trader means you need less, just like a master martial artist. You don't need a lot. It's very simple, very small moves, and you just need candlesticks and horizontal levels. That's the ultimate goal. So why do we have Fibonacci? Why do we have moving averages? We have these things as to help our baby eyes learn to read the hieroglyphics. It helps us organize what we see on the chart to help us see things that eventually we'll see without effort, but it helps us see it. So one of the things we can do, for example, and I'm going to show this, it's very cool, is we can use a 10 and a 20 moving average. Okay, so 10, 20, and 50, that's a terrible and sign. 10, 20, and 50 moving average, simple or exponential, it doesn't matter. And we put them on the chart, and they are great. The 10 and the 20 together are a fantastic way to identify where price, especially in a good trend, is going to provide us with an entry. Because remember, we want to find a way to, first of all, we now know what a chart is, what a trend is going to look like. We need to be focusing on trending markets. Now we know what a trend is going to look like. We'll see it on a real chart in a moment. Then I'm going to throw in the moving averages. The moving averages are almost like a train station. This is where price is usually going to come back to, usually. And this is where, in a nice trend, I'm going to be looking for an entry. The coolest thing about that is that there can sometimes also be a support resistance level there. This is very powerful stuff that I'm teaching here, and it should make sense to you. Trading is not voodoo. It's not wishy-washy. It is evidence-based. It is rational. It should feel logical and rational to you. So sometimes we get support resistance levels, horizontal levels, that arrive in those same places. And we have the moving averages coming up into that area, the train station coming up, and the train pulls back into the train station and it heads out. And now today, let's talk about Fibonacci. So Fibonacci was derived from, it's actually, there's a whole lot of original people that brought it up. It's not, it's similar to the number pi, 3.14 and so on. It's very similar to that. But it was effectively really made famous by Leonardo Fibonacci. Fibonacci was his nickname, and he was an Italian mathematician who lived around about 900 odd years ago, almost 1,000 years ago. And he was challenged with coming up with a formula for how quickly two rabbits could reproduce. So if you had no rabbits and then you had one rabbit, you still had one rabbit. But if you then had one rabbit plus one rabbit, you got two rabbits. Now that you have two rabbits and you added another rabbit, you'd get three. And the three rabbits and the two rabbits would become five, and so on. So if you added 5 and 3, you'd get 8. If you added 8 and 5, you got 13, 21, 34, and so on. So there's a sort of pattern of proportions as they go. So when you're adding the previous number to it. Now, then what happens is there's some other patterns that show up. If you take 34 and you divide it by 21. So I'm going to do a couple here. I'm going to take 13 and divide it by the number before it. And I'll take 5 and divide it by the number before it. So we'll do those. And then last thing we'll do, and this is Fibonacci. Next thing we'll do is take the 5 and divide it by 8. So now I'm going to take the smaller number and divide it by the larger number to its right. Or I'll take 13 divided by 21, or I'll take 21 divided by 34. And then there's a whole lot of other things. When you take 8 and divide by 21, we're just going to get lost. So, but let's look at the interesting pattern here. So if I take the second row over here and go 34 divided by 21, I get 1.61. 1.619, fine. If I take 13 and divide it by 8, 13 divided by 8, I get 1.62. If I take 5 and divide it by 3, I'm going to get 1.66. So actually the Fibonacci number closest to that, by the way, is 1.618. So it tends to orbit around the proportion. It's a proportion, that's all. Let's look at the bottom row here. So 5 divided by 8 gives me 0.62. Let's take 13 and divide it by 21. We get 0.619, which can be rounded up to 0.62. That's fine. And let's take 21 and divide it by 34. And that gives us 0.617. So we have a couple of numbers here. First of all, we tend to find that the number shows up here as 1.618. And the number here tends to show up actually as 0.618. It's just interesting. These are proportionate things, and these are Fibonacci numbers. So somewhere along the line, okay, they can be observed in nature. So if you look at spiral, let's go across to this, and let's just look at Fibonacci in nature, just to see this, because then you have to understand somewhere along the line, somebody said, I wonder if this shows up in the financial markets. So it's everywhere. It's in snowflakes, it's in the clouds, it's in proportions, it's in plants, it's in seashells, it's everywhere. Elephant's trunk, and there was somewhere here was like a chameleon's tail, all over the place. It's just insane. Somewhere along the line, somebody said, well, I wonder if it shows up in the proportions in the market. And as it turns out, it does. It occurs frequently in the markets. Thanks, Rob. I appreciate that. Oh, okay, so there's another question that's come in is, which time frame would you use to determine the trend? These rules, I'm trying to give you universal rules. These rules should apply in every single time frame. Okay, so this should work in every time frame and every market. So why are we going to use Fibonacci? Why are we going to do this? Is because these have also determined these proportionate moves in the market. The market often has a move where it goes 2 steps forward and then 1 step back, and that might be what we would call a 50 Fib. It's not a true Fibonacci number, but we would call that a Fibonacci level. Or it can come back as far as 618. So it can do almost a 62% retracement, or sometimes it'll do a 50% retracement, or it'll do a 38.2% retracement. Okay, so there's these proportionate when a market pulls back. Same thing on the way down, it'll pull back quite far. It can go as far as 786, but today we're going to focus on the 618. So it'll pull back 61.8 or carry on, or possibly pull back 50 and carry on, or possibly pull back 382 and carry on. Okay, so what we're going to be doing is using the Fibonacci tool to help see if there are any support or resistance levels at those key levels. So let me recap quickly before we go on. We're finding a market that is trending. We might throw on some moving averages. We don't have to, but I like them. I think they help us. We're then looking for a market that ideally we're trying to find an entry. So we're looking for a market that is now on its way back down. It's in a retracement phase, and we're going to be measuring the Fibonacci levels here. And we know that it's going to pull back to either a 382 or a 50 or a 618. And we're going to be looking for an entry in this area. And our expectation is, because the trend, because the tide, ladies and gentlemen, is going to carry it forward, we are expecting the market to turn in this area and continue onwards. That is the concept of what we're doing tonight. If we can find a Fibonacci level that overlaps a support resistance level, or potentially the moving averages as well. So in other words, we can find what we refer to as a cluster. If we can find what we refer to as a cluster of sort of bricks where the market is going to encounter orders. So one more thing I want to add to that. When we're on an uptrend, the beauty of trading with the trend, ladies and gentlemen, is that we're trading with the big fish. We don't have to, none of the video or sort of they're out to get me kind of things. We don't have to get paranoid. We are trading under the bellies or in the shade of the big fish. Okay, we're like those little remora fish that stick to the bottom of the whales or the sharks, eating all the bits that come off them. That's going to be us. We're trading with them because they're moving the market. And in that situation, believe it or not, most people, there are buy orders. So if the market's coming back, and this is most of the time, this is not 100% of the time, but it's 70 to 80% of the time, there are buy orders sitting here, meaning that when the market's coming back, most of the pros know that the market is going this way and they want to get in at a discount if they can. So they have buy orders down here, more so than sell orders. The sell orders are sitting up here, because eventually at some point the market is going to have a reaction when it hits the sell orders, and then it's going to come back. So usually the sell orders are sitting ahead of the market, the buy orders are sitting behind it, comes back, and if the trend is strong, it'll get more buy orders and keep going. And eventually at some point it'll run into a brick wall of sell orders. And on the way down, it's the same thing. So what we are looking to do here is to find an area where there are likely to be a lot of different buy orders in the same area. Traders who are using Fibonacci will have found Fibonacci support and resistance levels, and they will have put their orders there. There might also be a support resistance level on the chart, which could add to our case. We've got trend, Fibonacci level, support resistance level, and we're waiting for one more thing. There's one more thing from this list of ingredients. We are looking for price action, a candlestick. Candlesticks are just the most beautiful, amazing things in the markets. And as I get older and more mature and more experienced as a trader, I just love them all. So candlesticks, we're going to break into 3 categories to simplify it. It works this way. We're going with bullish, okay, indecisive, and bearish. That really doesn't help, does it? Okay. Either likely to go down, ones that can go, that are going to result in a turn in either direction, and ones that are going to result in a direction. So bullish looks like this. It usually has a nice long tail, wick, or shadow, and a bullish body. It's nice if it can close near the top. It's usually green. It can also look like this. It can just be a nice long box. These are bullish, nice and green. A bit of a tail. The best ones I like are the ones that have a very small wick on top. So it means it's closing near the highs. It's very strong when it closes near the highs. The indecision candles can generally be split into dojis or spinning tops, meaning small candles and small bodies with equal sized wicks above and below, equal sized wicks above below. And actually, if you had to zoom into that, so if that was a daily candle and you went down to the 15-minute, you'd actually see the market doing this. Okay, it'd be range bound during that period. And bearish. Bearish is the opposite. So here you might have a nice long tail, nice little rejection. It can come in various forms. It can look like this. You can have variations, or it might even be a nice bearish candle that closes near the lows. And these are red, generally. So we're going to do this. In an uptrend, you would expect to see more green bullish candles. In a downtrend, you'd expect to see more bearish red candles. And beautifully, 90% of the time, these candles will show up on the turning point. So if you have the market trending, you expect to find a lot of the bullish candles here for our entry opportunities. You expect to also see these ones at turning points. So indecision candles often show at the turning points, at the top and the bottom. So they can be potential trade entries, guys, can also be that. And the bearish ones, we tend to actually see those possibly at the top in an uptrend or in a downtrend. Okay, so let's go to the charts and start to put all of this together with Fibonacci. And let me check your questions again. Okay, so the time frames, everything here is on any time frame you choose. If you want to trade the 15 minutes, we will look at the trend and use Fibonacci on that. But it is interesting because some traders, other traders, while you are trading on the 5 minutes or 15 minutes, other traders are looking at the 1 hour and 4 hour. And is it possible that there might be a Fibonacci level near you that is from the 4 hour chart? It is. So we can actually look at that as well. So we might be trading the 15 minutes and identify multiple Fibonacci levels. So anyway, okay, so this is what we're going to be doing. Let's just have a quick look at a chart. We'll go through and let's have a look at some great charts at the moment. So we've got dollar yen. This is really good. And what I want to some little tips here about the daily. If we go through this, we'll have a look. And I'll show you Euro Aussie. So somebody had a question about, okay, well, what about a chart that's just starting to trade? So let's go and have a look at, let's do Euro Aussie, which is on my watch list now. So let's have a look at Euro Aussie. So to give you background around me, remember, I'm looking to trade. I'm a day trader as well. I've been doing a lot more day trading lately, and I'm looking to trade the lower time frames. So we're looking at the daily here. So the first tip that I want to give you as an sort of mental trader is that notice here we've got 1, 2, 3, 4, 5 days, daily candles next to each other like this, different shapes. The thing is that they're actually range bound. They haven't gone anywhere. So if you see a daily chart where your last 4 or 5 or 6 to 10 candles are side by side, walk away. There are no intraday trading opportunities on that chart. So in other words, if your daily chart is doing this, candles are going up like soldiers to the upside, that is fantastic. That is great for intraday. Go straight down to the 4 hour. I'm going to show you this. Go down to the 2 hour, 1 hour, 5 minute, 15 minutes, whatever. At least you know there's something there. Same thing. If they're going to the downside, you've got candles heading lower, day trading opportunities. But if you find your daily chart is doing this, where they're side by side, just forget about it, move on. So let me explain what I'm looking for on this chart to give you something here. We do have them side by side, and it'll make more sense if you then go down to the 4 hour. So let's have a look at the 4 hour. So the 4 hour, this chart has actually been trending down for a very long time. It's trying to turn around. So it's actually trying to create a little bit of a double bottom. So sort of coming down a bit of a downtrend, and it's trying to create a new uptrend. So once it breaks out here, it should work its way up to here. So this is on my watch list, not for trading now, but when it breaks out, that's what I'll be looking for. And again, that could be something that turns into a Fibonacci setup. Okay, and I'll be looking for it to break. So right now you can see it's got a bit of a level, it's struggling to break through. Now if it fails and goes this way, no skin off my nose. But if it does break through here, that is going to be a chart for me that I'll be looking to go long. If it tries to, it's range bound. So if it breaks to the downside, it should start trending because it's going sideways because it has no motion. Once it starts breaking out, it starts picking up motion, and then it goes onto my watch list for charts that are moving. And usually it'll just work its way to the next level. So here's another level that's valid. So if it breaks through here, I should have trading opportunities up to here at least, and then we'll see what it's going to do next. So I just need to keep an eye on what is the time frame that it's on, and I'm going to go further down. Let's go down to that 1 hour, and then just kind of squash it all together so I can see what's going on here. And this is what I'm going to be looking for. So again, I can throw in, just quickly moving my horizontal line, just put that in so that I do that. It does frustrate me a little bit that I can't save these as presets. I would really wish that I could just save that as a preset, but it doesn't do it for me at the moment. And I'm waiting, in terms of regulation, I'm waiting for a live account to do this. All right, so this is what I'm going to be looking for, just so you know, this is actually on my actual real life trading plan. I'm looking for this to break out. What I would really like to see is a really nice solid breakout candle that's going to be nice and green, and it's going to close out. Okay, so that should be a good start. The next candle will usually tap here. It'll look something like this. That'll be the next one, a little one with a little bit of a wick tapping here. And that's going to be a good indication for me that the market is probably going to work its way up to that next level there. And then I'll start going down to the lower time frame. So most likely that 15-minute time frame. And what I'm looking for the market to do, and I'm going to show you this, is then I'm expecting it to start to produce a trend. So similar to what you see here. So if I had to highlight, there's a nice little trend here. Nice little one where the market's coming back to the moving averages and heading off. I'm going to expect it to start to do that. The moving averages will start to fan out, and that will provide me with something to do. So let's go and see what this did today in terms of the markets. I'm going to go straight to Euro Yen, which is a nice little trading day. So this is the daily chart. Please note that the daily, look how just amazing, like soldiers marching up like that. So when you see this, when you see even as little as 3 or 4 days that are doing this, go straight down to the 4-hour chart, whether you are an end of day trader or intraday trader, straight down to the 4-hour, and you will see, generally speaking, a great looking trend. Okay, so when you see this, it is stable. The market is stable, and this is what we're looking for. Okay, so if I could go a little bit further down, let's go down to the 1-hour time frame. Again, okay, you can see largely the market sort of coming back to these levels. Okay, these are just great market trending conditions as well. At some point, yes, that trend is going to have to take a breather. So if we have a trend, let's just say that your daily is trending like this, your 1 hour is going to go uptrend, 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 and then your daily does a pullback or a pull phase. Your 1 hour goes into a temporary downtrend, and then your 1 hour goes back into an uptrend. So we always have to be aware of what is happening on the higher time frame to give us some context. When the higher time frame has got too overextended, far away from the moving averages, which are down here, it's going to have, that train is going to have to come back to the station. And so that 1 hour is going to go back into a downtrend, and then hopefully back into an uptrend. And I say that most of the time it will do that, but not 100% of the time. So when we are trading trends, we're trading stuff that tends to behave more predictably. Sideways markets are a little bit trickier to do that, so we tend to avoid those for now. And so what I'm looking for here is to find that if the market is going to be coming back, so at some point if that 4 hour is going to be coming back to the moving averages, what I'm going to be looking for ideally is to see if there is if there's going to be a way for me to potentially identify this. So using the Fibonacci retracement tool, blah, 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 blah. I've been playing with it the whole day. So I'm going to measure from the most recent swing low. So here's the thing. I'm looking for this to show me, actually before I do that, oh, forget about it. I'll come back to that. So what I'm looking for, remember, ladies and gents, is as price is trending up and it starts to come back, I want to find out where if there are any support resistance levels that I need to be paying attention to here. So I'm going to start with measuring from this high to this high and see if there's any levels that show up. I might also measure from this low to this high to see. And the question that somebody asked me was, do you have to measure on the same time frame? And you can measure from multiple time frames to see if there are any that actually, interestingly enough, that overlap. So let's just say that the market is going to come back down from here. I'm going to be looking to see if there is possibly a measurement. So let's go through, do Fibonacci retracement. And so here's my most recent swing low. So I'm going to measure from there up to the highs. And just for just for the purposes of that. So here I've got a 382. In fact, allow me to just edit it. Let's go through and just thicken it up so you can see it. And just change the color. There we go. And I'm going to be focusing on certain levels. There's the 382, the 618, sorry, the 50 fib, the halfway point, and the 618. So these three areas for me are going to be those are going to be areas I'm going to be looking for any potential changes. Now, yes, it is possible for the market to come back to do a shallow one or potentially come back further. But most trades, especially great trade setups, will occur on these three levels, within these three areas. And so that's what I'll be looking for. So one of the ways in which I could potentially look to trade this is I could simply place a buy order at this level if I feel that there is a lot of information there, and put my stop loss below this low. So the reason we do that, ladies and gentlemen, is that when the market is moving, we want to place our stop loss behind these because they're key market structures. If the market breaks that, then this uptrend, because every market goes through trending up, sideways, trending down, this uptrend is done. And so I want to make sure that I get out as quickly, like as soon as possible, that I know that that uptrend is done. So it's a great place to place our stop loss here and potentially place my entry order, my buy order in these areas. And so, and then usually just target. So we'll talk a little bit about the expansion tool in a second, and target either a 3-to-1, target, or again, just use a trailing stop if we want to do that. So there are ways in which we can place a buy limits order here so that if price comes down, taps that level, triggers me into the trade, and then turns around. Now, the confidence, because you might be going, yeah, but what if it's going to change trend? The confidence that this is, or the trust that we have that the market is going to turn around here, is really from this. We've selected a stock or a commodity or a currency that is currently trending, and therefore is obligated, if it's going to carry on that trend, it's obligated to carry on. Okay, so whereas if the market was very crazy behind that, then I wouldn't necessarily be so sure. But a trending market should likely build up and do that. The next approach, which is sensible, is to wait for price to pull back and produce, ladies and gentlemen, a nice small bullish candle in this area, okay, where the train station is. So looking to do that. So when the market pulls back, it's very nice, and this is one of my favorite strategies, is then to place my entry usually above 1 or 2 pips above the high of that, and my stop loss 1 or 2 pips below the low of that particular candle. And again, that becomes my 1% risk. Then I'm looking to target a 3-to-1 on average. So yes, some trades will go 4-to-1 or 5-to-1, and some trades will go 2-to-1, but the average big move that the market does is usually 3-to-1. So that's what I'll be looking to do, and then close out that trade. If the market's still trending, I'll get a second trade. But the goal is I can't really kind of make money until I close out those trades. So I need to get into the habit of aim for a 3-to-1, bank it, then either go to bed or get up the next day, look for another trade, or but have a system, because if I don't bank money, I'm going to eventually go broke. And so the trends that have worked have been phenomenal today, almost out of control, have been some of the yen crosses. They've been particularly aggressive producing, but these are good quality trends. Oil has also been on my, which I actually just swept out of it. If we have a look, for example, here at the S&P, let's go across to that, we have a downtrend. So this is a weekly chart, and the reason I'm showing you this is because we have a bearish candle that's come back to these moving averages. Let's see if it's pulled back to a Fibonacci retracement level as well. So I'm going to measure from there to there. And you can see it's pulled back to precisely, or at least to the 50% region. So it's in the zone, what we could call the zone. And it's also coming back to the moving averages. And so it's produced that bearish candle just off that 50 fib. All right, so if I pull it up to here, let's see if it goes back. So we're measuring now from a different, so in other words, from a higher time frame as well. You can see that it's really just sitting on that 382. So using two different Fibonacci measurements, I'll get a second one and measure from here. We have got very interesting. We've just got a 50 fib here and a 382 very close to each other. And so we often refer to that as a cluster. These two actually are better clusters. This is not a great example of that, but if we find two Fibonacci measurements really close to each other, that can often be where we are likely to encounter those orders. So often, especially if that then overlaps with support resistance. So here you can see there's a very nice support resistance level. And let's see if there's another one down here. If we come back into this area, you can see that there's also support and resistance in this area. So interesting enough that those two clusters, this is what I would call that, also tend to overlap, especially this one, overlaps with a very clear support resistance level in price action. So we would usually refer to that as a cluster and then be looking to place our sell order just ahead of that. So the idea being that if price was coming back, we would get triggered into it and continue with our stop loss above the high. So this is the general concept, but you can see that actually prices pull back into the 50 fib area. Is it possible that price might not trigger us in? It could come back and turn around before it hits our entry order? Absolutely. So again, there are two different ways we could do this. I can wait for price to come back to that area, produce a bearish candlestick, and then place my entry and stop loss into it. Or alternatively, not wait for it. I could see prices coming back up, place my sell order, walk away. And if this is happening on the 5 minutes or the 15 minutes or the 1 hour or the 4 hour, the daily, wait and come back and see later, price should potentially have triggered me in and continue down. In this particular case, I prefer the idea of waiting for the markets to come back to those key levels and then looking to see if we get a nice bearish reaction. Okay, so let me go and have a look at some of the other markets as well. I want to see your questions. I may run over by 1 or 2 minutes, and I'm just aware of the time. Multiple time frame analysis is also good. Start at the high level and go down to your time frame. That's very, very good advice. This is called the top-down approach, ladies and gentlemen. So you look at the daily, and then you go down to the 4 hour, the 1 hour, and the 15 minutes. You're looking to see ideally the market conditions continue. So you want a really nice trend on the lower time frame. A doji can often be a great. Let's have a look at this chart, for example. So let's go through to, let's see if Bitcoin as a crypto. So we're just choosing crypto here as an example. You can see how you often get the little indecision candles at the turning points. They can occur in the middle, but they occur a lot of the time at the turning points. So little indecision candles can be great entry points. So in a downtrend, you might be looking for those to find a nice entry, especially imagine if it lines up with a Fibonacci level. Sorry, I was trying to draw on a Fibonacci level there. If that lines up with it, you can see them also here. So they can occur, because effectively they are just small versions of ranges before the market decides what to do. But look, there's a little indecision candle there. So they often occur at the turning points. So what actually happens is you get a small candle that then goes to a bigger, and then a big candle, and then it goes small again, and then it goes in a trend down, sort of bigger candles, small again, bigger candles, smaller candles. So the smaller candles are those indecision candles that occur at the turning points. I have jam-packed, I've just brain dumped so much information on that. I do apologize. I hope that that's okay with you. Sort of brain dumped quite a bit of that. And I also wanted to just talk about that. So let's have a look. So for example, if we look at Bitcoin now, there's no point in trading it right now. This is the daily. And if you see, you've got about 20 to 30 candles almost side by side. So this is just an absolute mess. but when it does finally break to the upside or to the downside, and these indicators are bullish, they're trending up like that. So you notice how the market's going sideways, but the MACD is trending up, and the RSI is trending higher. These are bullish. That usually means that the market is generally closing to the upside, and that could hint at its ultimately breakout to the upside. But if it breaks down to the downside, there'll be quite a strong move. Okay, let me have a look at your questions, and then I also want to just do a recap. Is it possible to get a recording of this session? It is recorded, and to my knowledge, I'll have to check. Have any of you who've attended webinars, these IC Markets webinars before, do you get a follow-up email that tells you if there's a recording or not? Failing that, if you have never had that happen, if you send me an email to Adam@TradeWithPrecision, if you haven't had that happen, not like that, I will send you a copy of to the link of the recording. Okay, Adam@TradeWithPrecision.com. I will send you a copy of that. Okay. So let's have a look here. So let's just recap on what the concept was today. We were looking to find a good trend, find a healthy trend is a good idea. We could also, excuse me, we were looking to identify potential support levels or support resistance levels using the Fib retracement tool. I'm going to run over by a couple of minutes because I also want to show the expansion tool, and I just want to recap on this as well. We can also look for correct candlestick. Oof, I'm sorry why I keep hitting. I'm sorry that I keep hitting all these different things. Candlestick in the either the Fib area, which is the 382, or the moving averages, which we've said are just a standard 10, 20, and 50. Let's call it the zones. And for obviously target a 3 to 1, for example, or 1 to 3. Doesn't matter which way you say it, as long as you know that it means you're targeting 3 times your risk. And so ideally, better if Fib levels are on top of SR levels, other things as well, for example, more evidence, for example. So let's just go and have a quick look at this. I'm going to quickly show you the Fib expansion tool, and then I'm going to recap one more time, and then we'll wrap up, because I realize for you this has been so much information, and my goal isn't to leave you hanging. It was just to introduce you to this. So the Fib expansion tool, which is listed under the same menu here, is one tool that can be used, expansion or extension can be used to identify potential targets. Okay, instead of a 3 to 1, you may use the Fibonacci expansion tool. So the way that I like to use it, this is the way that other people use it on this platform, is to click. So what I'm going to do here is we've got to move down. Price is pulling back. Actually, let's just do this, and I'll just bin that. I'll come back to it. So for example, what I want to do is price is coming down. It's pulling back. I'm looking to get in here, and I want to measure how far it might potentially go. So I'm going to measure from here to this low and back up to here. It's a 3-touch tool. Okay, let's have a look at that. So one example might be to measure from here to this point and then back to this point. Okay, and you'll see how nicely it identifies these potential support areas. So it produces a 138. The 1618 is a very popular. So again, this is difficult, I appreciate, to see the size of that. Let's see if we can thicken these things up. Just make it nice and thick. It doesn't really increase the size of the font, but we have a 1618, 1382 could be in. So imagine price pulls back. There's a setup over here, and we see a nice extension down. So these are just possible ways in which we do that. Okay, so that was really by clicking. I'll show it a second time. Let's see if I could find a nicer move. So we'll try it like this as well. And I prefer to do it this way. It's got a 3-touch thing. And so sometimes people, for example, will do a touch here, a pull back to there. Did we do that right? Let's go Fib extension, Fib expansion. do it. So let's just say we decided to get in here. Okay. That's interesting. Why is this? This doesn't feel right. There we go. There's the third one. So there's it. So some people like to do it this way. So it measures the third touch and then tries to identify a target this way. But actually, again, I prefer to do it back to the original here. And so it can identify some really nice targets. But notice how well it identifies support resistance levels. Very, very powerful. Again, if we go back to the Fibonacci retracement tool and we measure this. So for example, I'm going to measure down. Oh, it must be me. You know what? It must be my mouse. So if I measure down to here, see how price comes back and connects with these levels. So there's your 50 fib, your 618's up here. You've also got the respect of the 382 there. And again, we could do it differently. So we could go up here. We'll measure up from the top here. We'll just measure from any of these where we've got a nice little pullback. You see, for example, here, all the way down there, pulls back to the 382. So just to sum up, think of the Fibonacci retracement tool as an additional tool that will, because some traders use support resistance levels, some traders use Fibonacci levels, some traders use pivot levels. And tonight, we're talking about using the Fibonacci tool to identify those support and resistance levels, and then to see if there's anything else. So for example, here, that is a Fibonacci level, it's a 382, but it is also clearly, if you look here, the support and resistance tool. You could see that measured up. And so there we found two reasons why if price was pulling back to that, we'd be looking for an entry at that point. And we spoke also about placing an order ahead of that so that price triggers us in, or waiting for price to produce a bearish candle, nice little red candle in a downtrend, or a nice little green candle in an uptrend. So I also wanted to show you we had some strong trends at the moment, not so much on gold. And if we look at gold, as I said, last 4 days, it's in a little bit of a range. It's not trending. Here you've got a nice little bit of trend. It's going sideways. I'm looking for gold to break out, ideally to the upside, but there just isn't a big clue in that at the moment. If we look at the S&P, we've got a weekly trend that is potentially going to head lower. So this is my concern. We've pulled back. We're in a downtrend. There is the possibility that the market could head lower. We'll see if that's going to be the case. And as I was saying, Euro Aussie is sitting on my watch list to break out to the upside, and then I'll be looking for trades up to these highs here and looking for price to pull back to Fibonacci levels and looking for entries on those levels. I also mentioned, for example, that the yen pairs have been offering quite a bit. So if you go and have a look at Euro, GBP yen as well. So the most powerful ones at the moment tend to be the yen crosses, not so much the indices. They're looking quite bearish. You can see how strong this is at the moment. This is the 4-hour chart for pound yen. We could go down to a 1 hour or possibly even say a 30 minutes or 15 minutes. Let's see what that 15 minute looks like. Okay, so here, for example, we are measuring from this low up to this high. You can see price pulling back and finding some strong support on the 618 or even the 50 fib, which is touched upon here, and the 382. So we're just looking to identify those areas of support. The clue usually is if you get a nice strong bullish candle in an uptrend, the bullish candle is usually the buyers are returning to the market before they head off. Okay, so the last look at the questions, and then I'm afraid we need to wrap up for today. Wow, look at the questions. I like it. I'm not that's fantastic. The moving averages, ladies and gentlemen, are straightforward. I'm using 10, a 50 in red, a blue 20, and a 10. Okay, simple moving averages. These are, again, not nothing too complicated on that. Okay, red 50, blue 20, and 10. Either simple or exponential, doesn't matter. You see the difference between them is only about a 10% difference. It's very minor, and it doesn't change anything too much. What is the 50 MA? So great question. The 50 moving average just tells you that the trend is established. So if you look at this and you've got a nice trend, you will find that they're in a certain order. It's called order, angle, and separation. So you've got 50, 20, and 10, and price. And price is on top of the moving averages. None of you strictly need the 50 moving average, but if you add it, it's just that extra visual confirmation that the trend is established when you have them all in the correct order, sort of order, angle, and separation. when price action is sitting on top of the moving averages and it's a bird's nest and it looks like all those cables under your desk, then the market has no clear direction, doesn't know where it wants to go. We want to stay away from that. So as they start to fan out, they look good. So in addition to the price action, what I wanted you to do tonight was to get a sense of looking at the candlesticks first, the lows and the highs first, rather than waiting for moving averages to cross over. But the moving averages can still be used, but you should always look at the candlesticks first. I'm almost done with the questions, ladies and gents. We can screen record. Yeah, but there's a recording. There's a recording. If you send me, honestly, if you send me an email, then I will send you the recording. Okay. Oh, and that email. Okay, we'll have a look at that. Okay, so that was Adam at Trade with Precision. How are the 3 moving averages on your chart used to decide support resistance? Think of them as an organic trend line. Often price just interacts with them. They connect, they follow price, price follows them. Some traders use moving averages. So again, what we're doing today is we were talking about how to combine all those different things, but Fibonacci, throwing Fibonacci in, and some people have never heard of Fibonacci as well. Okay, expansion. We discussed that one. What are the values used for the MA? There we go. If you have time, could you show us at least one take profit strategy? The 3-to-1 is a great one. So I target 3-to-1 is definitely the best as that. I think, I'll tell you what, Thomas Lev, if you're in the next webinar, I'll remember your name. I'll show you in the next webinar as well. Or if you send me an email, I'll send it to you privately as well. Not a secret, just if you ask for it. Thank you very much. No, so I have a Robert. I have a YouTube channel as well where I cover some of these things. This video isn't there. And there we go. Okay, great. Thank you very much. And I really appreciate it. And thank you from Kenya as well. Brilliant. I know that all of you, some of you are all over the world, and I really appreciate that. Let me go back to the platform. There's one last question before I wrap up, which was, is projection and expansion the same? And I don't think it is. It should be. So Fibonacci expansion and projection or extension are the same. Yes. Yeah. In terms of that, they are the same. Okay. So they should do that for you. But again, there's 2 different ways of measuring it, and I like to measure from the start to the finish, back to the start, and get that out as well. And that's just an aim for that 1618 sort of target. Failing that, ladies and gentlemen, just use a 3-to-1 target. 3-to-1 target is just the straightest, most sort of go-to approach. Okay, generally accepted. Okay, thank you. And so there's a question here saying, and I'm not laughing because it's a good question. What is the best trading method? It's a complicated question, but for me, and it's a personal biased response, it's trading a trend with the trend, risking no more than 1%, targeting 3-to-1 is the best trading method in my approach. Suits most people, gets most people to a point where they can at least go, okay, I can do this, I can make money doing this. And then from there, if you want to mix it up, do other stuff, that's fine. But give you the basis for trading in the markets on a consistent basis. Trend-based trading, price action, candlesticks, 3-to-1 target, risk management, and practice. There we go. Thank you, guys. We've run over by 10 minutes. I apologize. I want to say thank you for your time. I really appreciate it. I do look forward to seeing you in future webinars. Don't be shy. Write down questions. Bring me the questions. Sometimes the amount of content isn't as complex, and we do more market analysis. But today we had to talk about a lot of stuff. So thank you very much. I do appreciate that. And bring your questions, okay? Thank you very much. Have a great week and weekend. Thank you.